In this video today, I'm going to help you perfectly understand some complicated capital gains math with this matrix right here. Along the way, we'll show you some very common and very costly capital gains mistakes that we see from investors on an ongoing basis. Let's get in. There are two types of capital gains that every investor should be aware of. You have short-term capital gains and long-term capital gains. Now, short-term capital gains are from investments that have been held for less than 1 year. So you bought this less than 1 year ago and you're selling it within 1 year. A long-term capital gain is then from an investment that you've held for longer than 1 year. Now, as a general rule of thumb, we never want to pay a short-term capital gain. The reason being is because short-term capital gains are taxed at a much higher marginal rate. We can see when we compare ordinary income rates to long-term capital gain rates, at every given level, we pay less taxes if we're capturing income, that is long-term capital gains, versus ordinary income. Now, here in 1 second, I'm going to show you how you can actually take a short-term capital gain and avoid paying taxes completely. But before we dive into that, one of the most confusing parts of the capital gains tax system is that when you sell an ETF, a single stock, or a mutual fund, and you have either a capital gain or a capital loss, this is not a standalone taxable event. In fact, it's commingled with the rest of your capital gains or losses throughout the year. Here's a roadmap that we call the capital gains matrix that will help you perfectly understand these relationships. On the x-axis of this matrix, we have whether this taxable event is a short-term taxable event or a long-term taxable event. Then on the y-axis, we have whether it is a loss or whether it is a gain. Now let's walk through a number of examples with this matrix to help remedy a lot of capital gain mistakes that I often see from retirees. Very important to understand a concept right at the start here called offsetting. For instance, let's say throughout the year, an investor had some long-term capital gains from investments that have done fairly well. They also had some investments that simply didn't pan out that they ended up selling. And because of this, they had $10,000 of long-term losses. Well, within each category, both long-term and short-term, your gains will be offset by losses. And so for this specific example, this retiree would have $12,000 in long-term gains for the given year. Pretty simple and straightforward, all things considered. This $12,000 would be taxed at their preferential long-term capital gains rate, and they would pay the given tax that they would owe based on where their taxable income falls. But let's look at a different situation where rather than having net gains, we had net losses. And so let's take an investor that had a pretty bumpy year in investing, and they sold off some stock in both categories, short-term and long-term, and both were at a net loss. So in this situation, we're going to look at $3,000 in net long-term losses and $7,000 in net short-term losses. When we have a net loss, some pretty advantageous things can happen on the tax side. So first, we can offset our income in that given year by up to $3,000 for a married couple and up to $1,500 for a single filer. So let's say that we're married and we had $10,000 in net losses in 2022. Well, we can take $3,000 of that $10,000 and offset our income. And so let's say that we're in the 24% bracket. Well, now we essentially get a $3,000 deduction within that taxable income where we offset $3,000 at 24%. Now, after offsetting our income, we still have $7,000 of net losses. So what happens here? Well, now we have what's called a carry forward loss. And so we can do two things with a carry forward loss. We can take $3,000 of that loss and keep carrying that forward into additional years. The second thing you can do with a carry forward loss is you can carry forward an unlimited amount of net losses and offset future taxable gains. And so, for instance, we could take that $3,000 net loss off of our income this year, but then next year, let's say we had $7,000 in capital gains. Well, we can take that carry forward loss and offset that $7,000 in taxable events next year. Now, a very important thing to note here is it doesn't matter what kind of net loss we have. It doesn't matter if it's long-term net loss or short-term net loss. If at the end of the day we have net losses, we can offset our income. If you have a long-term capital gain, you are taxed at preferential tax rates. But if you have a long-term capital loss, now we can offset our income. This means we have an asymmetric tax trade-off here. Because when we have a gain, we are taxed at preferential rates, but when we have a loss, we're offsetting very high rates. Where things get quite a bit more complex is where we have gains in one category and losses in another category. So what exactly happens here? Let's say that throughout a given year, there were a lot of tax changes made within our taxable account. And we end up where we have a long-term capital gain for that given year, but then a short-term capital loss. So in the offsetting rules, what happens here? Can we pay our preferential tax rate on those long-term capital gains And can we take those short-term losses and offset our income? And unfortunately, the answer is no. So gains and losses first offset one another in each category. But then from there, they cross over categories and offset one another as a second layer. And so in this specific situation, a long-term gain would be offset by short-term losses. So for this situation, this couple would have $14,000 in long-term capital gains in this given year. Now, this leads us to mistake number 1. Now, sometimes this mistake is completely unavoidable, but we should try to avoid it if we can. If possible, we want to offset strategically, and this is an example of not being very strategic. We're taking a short-term category that has higher rates, and we're offsetting a much more tax preference category in long-term rates. Generally, we want to avoid this. Let's look at another tax scenario. In this example, we have a net long-term loss of $15,000 and a net short-term gain of $10,000. For a tax-minded investor, this is a tax dream. If we didn't have those long-term losses, we would essentially have $10,000 of short-term gains, which would be taxed at those very high ordinary income rates. But luckily, long-term losses completely cancel this high tax gain out. Not to mention, we can take $3,000 of that long-term loss and offset our ordinary income, thus lowering our taxable income by another $3,000. And then we can take the remaining $2,000 as a carry forward loss against either next year's income or against future capital gains. So our long-term losses were essentially able to offset $13,000 in income taxed at ordinary income rates. This is some powerful stuff. Now, note the situation in the example we just showed is a little bit harder to achieve. The longer that we hold investments, the more we expect those investments to grow. So we generally have long-term capital gains rather than long-term capital losses. However, if your advisor is managing this complex capital gains situation correctly, they can be raising your cost basis through time and thus opening up additional opportunities for this strategic offsetting. Now that we understand this capital gains matrix and we understand some of these offsetting rules, let's talk about some common mistakes that cause retirees to leak taxes from this taxable account. The second mistake we see is oversimplifying your taxable account. Now, I'm a big fan of simplification, but not when simplicity costs you. For instance, if you are holding one fund in your taxable account, let's say this is a total stock market fund, so it encompasses the total stock market. This is costing you significantly. The reason is when you hold one fund, you have absolutely no control over strategically managing your capital gains and losses from year to year. If instead you use a strategy called yield splitting and you break down that total stock market fund into smaller components, you will gain additional opportunities to capture gains and losses and use offsetting strategies. For instance, so far in 2022, growth stocks are getting absolutely crushed while value stocks are holding up a little bit better. And so by yield splitting, you gain the opportunity to capture losses from those growth stocks and either offset other taxable gains you might have or offset ordinary income. Mistake number 3 is realizing income without first offsetting. So within our taxable account, for simplicity, let's say that we have two ETFs, ETF A and ETF B. Now we're going to sell some of ETF A for income and we're going to incur a long-term capital gain that we're going to pay 15% on. So too often what I see from retirees is they take the income from ETF A and that's it. They pay their given taxes and move along on their way. What this person should do instead is tax loss harvest ETF B. By doing so, they'll completely wipe out whatever taxable event they had from ETF A and pay a 0% tax rate on the income they took from ETF A. They then buy an ETF that is similar to investment B, but not substantially similar in the eyes of the IRS. Now, this can get quite confusing and brings in other rules called wash sale rules. I'll record future trainings on this exact topic, so it completely clears up any confusion on this front. Now, they did reset the cost basis of ETF B, so when ETF B does recover, and they then sell ETF B, they will owe a long-term capital gain. But as you'll see here, from the tax that they avoided this year, they can now earn interest on that given tax that they avoided, thus overcoming whatever tax they owe in the future on the gain from ETF B. Mistake number 4 is holding mutual funds in your taxable account. Now, mutual funds are one of the worst investment vehicles to hold within that taxable account because when you put money in a mutual fund, you give up complete tax control to the mutual fund manager. Mutual funds are a pass-through entity. This means that anytime the mutual fund manager is buying or selling a given investment in that mutual fund, it is passed through to investors and can create a taxable event. So often what you'll see when investing in mutual funds is a massive tax bill at the end of the year due to capital gain distributions. I guarantee many of you watching this video had a pretty big tax bill in 2021 due to holding mutual funds within your taxable account. This can lead to you perfectly managing your offsetting situation throughout the year based on that capital gains matrix, only to find at the end of the year you have a capital gain distribution of $20,000 from your mutual fund, and now you can throw your whole tax situation right into the trash. And so managing this capital gains matrix correctly happens right from the get-go. What you hold within this given account makes the world of difference. Now, we have 5 critical taxable account rules that you need to follow in order to manage this account correctly. Not holding mutual funds is just one of those 5 rules. For the other 4 rules, click on this video right here. Taxable accounts are one of the leakiest buckets for retirees, which is a shame because they should be one of the most powerful. Click here to learn more. Always remember, you don't need more money, you need a better plan.